Well, thank you. Thanks,
yeah,
everyone.
thanks, Haven. That was great.
So we've got our agenda. I'm Dave Habiger, and I'll be throwing out the questions for Austan. We have some prepared questions for him, or some that were gathered, and I think we're going to do a real-time Q&A after the first 30 or 40 minutes of the first version of these. So everyone get your apps fired up, and it's exciting to be here. We had a board meeting today. I'm on the board at the Chicago Fed, and so a full day of economic discussion and a lot going on in the world. And thanks for hosting. So any intros, Austan, before I pepper you with all the hard questions? I've got really hard ones.
I'm the president of the Chicago Fed. It's good to see some old friends and some new faces. Before I started at Chicago Fed in January of 2023, and before that I'm 30 years or so on the faculty at the University of Chicago Business School. So I know a bunch of you are Maroons, and look, our region, we'll get into it. Our region is the most manufacturing intensive of all the regions of the country, and that within the Fed and the setting of monetary policy, our 7th district and the Chicago Fed is really, if not spokesperson for the Midwest, is on everyone's mind. What the Dallas Fed is to energy, as I say, that's what we are to manufacturing. And so whenever anything happens, they call us. What does this mean for manufacturing? So I'm going to ask you, and then I'm going to have plenty to provide.
Well, good. We are, I've got these are not softballs, Austan.
Oh, great.
Yeah, you get ready. No, you're, maybe, well, why don't we start with what's the role of a central banker? And maybe more importantly, what do you do all day? What are you doing?
I often say that the role of a central banker is you're kind of the night's watch, and your job, and they say, what keeps you up at night? Your job is not to be sleeping at night. You're supposed to be up at night, and nothing should be going wrong that you haven't at least thought about the scenarios. What could it be, and what would we do about it? A dear friend, mentor, personal hero of mine was Paul Volcker, the old Fed chair, which most people say the greatest Fed chair of all times. And he was involved with the Obama administration, and outside he ran the Economic Recovery Advisory Board, and I was his chief of staff and the chief economist for that. And he was fundamentally a very pessimistic person. And he used to say, I would be like, that seems kind of grim, whatever. He'd say, there is no silver lining bright enough that I cannot find a dark cloud to block it out. And so there is a little bit of a cultural thing maybe from him, but central bankers are supposed to be dour and think, that the world is going to end. I don't view it that way. And the Central Bank of the United States is different than almost all the central banks around the world in that we have a heavy regional component. We have these 12 reserve banks, and usually the way that somebody would ask the question is, why does Chicago have a Federal Reserve Bank? Why isn't there just one in D.C.? And the answer is because when they made the Federal Reserve System in 1913, just like today, people were deeply uncomfortable with the idea that Washington, D.C. plus Wall Street would together control the entire financial system and setting of monetary policy with no input from the rest of the country. So they purposefully designed it. And it can be kludgy if you really want to get into how the voting rules work and why there are 12 and why does the state of Missouri have 2 of them, Kansas City and St. Louis? It's because they needed the votes of the Missouri senators, so they were like, we'll give you 2. Fine.
I know that.
There's kludgy parts of it, but the basic insight that you should have monetary independence built in to represent all parts of the country, that's a pretty powerful idea, and that's proved pretty useful. So then if you say, what do I do all day besides have to answer to my board, and taskmasters like Dave, there's mostly 5 functions of the Fed. They talk about the 5 functions of the Fed. The thumb, as I like to call it, is monetary policy. That's the one everybody knows about. We go every 6 weeks to Washington, D.C. We vote on interest rates, the short interest rates, not long rates. So if you're complaining about your mortgage, don't complain to me. I didn't do that. You got problems with the market. The monetary policy is the opposable thumb, and that's what separates us from the animals. But we also monitor financial stability, and the reserve banks do the lender of last resort. So if stuff goes wrong, our job is to be guardians of the galaxy and try to prevent and monitor and prevent financial instability and be lender of last resort. We are supervisory, regulatory on banks, on our member banks. The actual supervisors, Congress will pass a bunch of laws. You must have capital ratios, liquidity ratios, et cetera. The actual bank supervisors are going down to the bank to check to make sure that they're complying. There's some at FDIC, there's some at the OCC, there's some at the Fed. It depends what member bank is. 4.
Five.
Well, yeah, there are 5. The 4th is we are a bank to banks. So we provide a bunch of financial services. $5 trillion per day go in payments over Fed rails. Okay, so wire transfers, ACH direct deposit, FedNow instant payments, all of those are heavily going over the Fed rails, and all the cash in America is printed at the Bureau of Engraving and Printing and then is distributed through the Federal Reserve banks. So we have a vault with billions of dollars of cash sitting under there, and the machines are running, pulling out the counterfeit, and the banks are sending armored cars, and they're like, we need money for our ATMs, take it out of our account. And we're a bank to banks. They have a master account, and that's an operational aspect. And then we are to represent and be members of our region. We have a community development function, and we go out and gather business intelligence from our board, from mHUB, from all around. And so between those 5 things, it keeps me busy. I was
trying to throw you off on the 5. I was
guy.
going, you're on 3, and I thought, okay, now you're on 5, and you pulled it off.
No, they were 5.
Good with the numbers.
I remember it with my hand. It's like,
The opposable thumbs. I'm going to rewind the tape and go to, there's a good Volcker story about furniture that a piece of furniture from Chairman Volcker.
It's not, it's a little farther below the supply chain. He got sent famously to, inflation was out of control. They literally had to raise the Fed funds rate to 20%. Okay, the thing that we're arguing about now of like, we're at 4.5 and should it be 3.5? 20%. They had to raise, and they had to hold it there, and they began sending him 2x4s and pieces of this. You're killing us. And the first one is scribbled on it. It's about this big, and it says, please lower these insane interest rates. And when he passed away, his wife gave me this thing, and I have it in my office to remind me, to remind me of him, but what we do matters to regular people, matters to manufacturing, matters to construction, matters to a bunch of interest rate sensitive sectors, and also to remind you, the Fed's job is not to be the popular person, at the party. Sometimes the Fed has to, it's why Fed independence is critically important. There's sometimes when nobody's happy with what the Fed has to do, but as I said to Volcker at one time, I was like, it was the coming out of the financial crisis and how we're going to get out of, interest rates are all 0, and at some point we're going to have to declare, no, the crisis is over. And I said, that's going to be one of the hardest political things that the Fed has had to do since you had to raise the interest rate to 20%. And he said, I'll tell you a secret. It wasn't actually that. It was hard to stick with it, but everybody knew that it's what had to be done. They just couldn't publicly say that. And he said that made it at least in a way easier than trying to figure out when is the moment when you start raising for the first time.
Well, I'm going to skip a couple here because we hit.
That was a subtle way to say, man, that was way too long
No.
for the first answer.
You know I have a look.
You set it up.
I'm not afraid to jump in.
You set it up. Yeah,
No, you make
set it
my
up.
job
What do
easy.
You do
I
all
just
day?
drop
Yeah.
on and you go.
Yeah.
I was thinking about dinner. I was
Okay.
I knew to come back in. I've redirected my attention. I'm going to go to Midwest economy.
Okay.
So there's a bunch here, but why don't we start with what are the key economic trends shaping the Midwest, so 2025,
Yeah.
and how does the Midwest region compare to the national economy? So we are,
Okay.
we're the Midwest hub. How do we
This
fit
district, Chicago Fed is a home base and has a branch office in Detroit. Covers 90% of Iowa, Wisconsin, Illinois, Indiana, Michigan. So it's kind of heart of the Midwest. It is relatively more manufacturing than any other district. It's by far more autos production than any other district. And it's more intensive agriculture, some transportation, logistics, as you might imagine, and some professional services. Our least thing compared to the nation is mining. We don't have very much mining, but most districts is sort of national in nature. So most of the shocks that are hitting the country are hitting everybody approximately the same. That said, you know how it works. The economy normally, demand goes up, demand goes down. There's overheating, the unemployment rate goes down and inflation goes up, or we go into recession and it does the opposite. Inflation kind of comes down and unemployment goes up. And the way it works, and the reason the central bank is the tip of the spear for stabilization, is we sort of have only one tool, is a screwdriver, tighten it, loosen it. The interest rate sensitive parts of the economy are usually the most cyclical parts of the economy. So it basically works. So it says, okay, if we're overheating, who's overheating? The most cyclical parts of the economy, which include, it's usually construction, durable goods manufacturing, business fixed investment. So to be especially manufacturing intensive, like the 7th District is, usually means you're the canary on the business cycle. So there is a sense in which a lot of the Fed or a lot of analysts will kind of look to what's happening in 7th District as an indicator of where are we in the business cycle and what might the Fed be doing. Scrambled, well, I love that we began with that image of, 6 years ago, and Chair Powell has been named the chair. He comes to Chicago and gives a speech. He comes to mHUB. Yeah, we're going to, the interest rate's probably zero, where it's been, for a long time. And just roll your Back to the Future style. You go back to 2018 and you're like, hey, let me tell you what's about to happen for the next 6 years. We're with this and COVID, we're going to have a single month where they announce we lost 20 million jobs in a month. The unemployment rate goes up. Then it's going to come crushing down. The supply chain's going to be completely disrupted. Inflation erupts. Then we're fighting the whole thing back, and then we're going to wind up back in this system where we are now. What's the state of the economy for the 7th District at this moment? It might be steady as she goes. It might be deteriorating. The labor market might be deteriorating. But it's also an environment where inflation is kicking back up again. And so people are nervous on both sides of what we call the dual mandate. The law says when we set monetary policy, it's to maximize employment and stabilize prices, which we've interpreted to mean get inflation to 2% and hold it there. And so we're always talking about the two sides of the mandate. Tariffs are a shock that is stagflationary in direction, meaning they both get worse at the same time. It's not like a normal recession where inflation's coming down while unemployment's going up. Here, you're losing employment and prices are going up at the same time. So I think there's a bit of wait and see because of this uncertainty, some of which is coming from policy and some is coming from others.
So we've got a jobs report tomorrow morning, monthly
We have a jobs
report.
report tomorrow
How
morning.
does that influence the way you think about monetary policy?
At a high level, influences it a lot, not 1 month necessarily, but the job market is in the dual mandate. So if we feel like the job market is deteriorating, that's going to be a thing arguing for maybe we should loosen. What's been hard, it started being hard the easy way last year, which was we started getting these huge job numbers. We believe that the break even of are we overheating or underheating was around 85,000, 90,000 jobs a month. We were getting 185,000 jobs a month. So there were some people saying, the economy must be overheating. We're so far above the break even. Inflation must be about to reignite. But it didn't. It never did. Inflation kept falling and falling, even though we were generating these kind of jobs, because there was all this immigration that we weren't paying attention to. Labor supply was coming in an unexpected way, and that was adding to the jobs numbers. So the raw number wasn't that great an indicator of where we were in the business cycle. Now we're starting to get surprisingly low numbers. We got these revisions on the jobs numbers, and we've been averaging so far this year 35,000 a month. One way to look at that is to say, that's a really low number. We must be on the cusp of recession. Maybe, but if labor supply is phasing back and if immigration is low for exactly the same reason it wasn't a sign of overheating last year, it might not be a sign of underheating this year. So we're trying to figure that out, and that's got me putting a little more. I'm one of the data dogs, so you're never going to hear me say throw away a number and pay no attention to it. But I'm just going to index on that number tomorrow morning a little bit less than we normally would, because what we found in 23 and 24 is rates were a little more indicative of the business cycle than the raw jobs number. And the four horsemen of truth are the hiring rate, the vacancy rate, the layoff rate, and the unemployment rate. Those were a little better indicators than was the just raw job growth. And I will say right now, one of those four looks pretty weak. That is, the hiring rate is not great. The two of the four are totally stable. And one of the four, if you look at layoffs, the layoff rate is extremely low. It's lower than it was in 2019, for example, which was a strong labor market. So we got some cross currents that I'll be looking for tomorrow.
Yeah, when you describe what you do every day relative to that, it struck me that I think that's what maybe a lot of people don't appreciate. You actually have to, in your role, and I was involved in the search committee, you've got to run a bank with real money coming into it every day, security, employees, doing the town hall. So you're running a business, a complicated one. Yep. You've got to understand monetary. I've been on this board a long time, and I still am amazed at how complicated it is. And then you've got to actually be a face to, there's a public dimension to this job. So
it's like one of those TV projectors with the three colors in there.
You got it, and somehow there's a thing that comes out of it.
I mean, there's almost 1,700 employees at Chicago Fed, and that's the magic sauce. I mean, we've got a very large, very respected research department that I knew a bunch of the economists when I was just a research professor, who are very adept at analyzing where are we in the economy. If I have questions, they might be crazy questions, or they might be right on there. And they're really good at analyzing it. We have a COO, this woman, Ellen Bromagin, who's an absolute rock star, who helps make sure that the bank runs. And I'm not going to put Dave on the spot, though it is the origin of this came from Dave. There is a sense in which working at the Fed, it's never going to be the highest paid job in the financial sector, okay? But it's very likely to be the most mission-driven and the most meaningful job in the sector. And there is a sense in which the Fed is 85% NASA, but it's also 15% working at the DMV. And it's like, you know what I mean? You got to balance it. You know, there's a lot of rules. There's a lot of bureaucracy that comes from, you got Washington, you got all this thing. And part of the management of the bank is you got to keep the 15% under control and enable. Why does NASA get such amazing engineers? Because there's people, they want to put something on the surface of Mars, and like, NASA's one of your only job options if you're like, I want to, you know, find life on Mars. And the Fed is that. I tell the people, they're believers. I mean, if you go meet the people at the Fed, the Fed's part of the universe is only as narrow as this. But man, in this part of the universe, it makes a huge difference. And we're not the bad guys. We're the guardians of the galaxy on this part of the universe. And our folks are very talented and they're believers. And I tell them every time, I'm like, look, you're doing God's work. If God had to figure out the liquidity ratios, he'd be doing this. He'd be working at the Fed, and that's what it would be.
It is an impressive, I mean, it really is. I'm amazed at the talent that is there. And it's a hard job. All right, I'm going to go to, one last question on labor market, just since we're at mHUB here, on manufacturing growth. So when you think about the current labor market and sustaining advanced manufacturing growth, how does that factor in with software technology? I mean, the Midwest is unique in this situation. I mean, do we run out of people that can manufacture? I mean, how do you think about it?
I mean, one of the biggest issues of the last several years, as you know, has been attracting talent. And we've gone around to manufacturers. What is your biggest problem? The unemployment rate is in the 2s, and we can't get anybody to come over. And we need skilled labor, and skilled labor's in short supply. And the pipeline generating new skilled labor is only coming out at a flow of a certain speed, and that's a limiting factor. When you ask it with the word sustaining, it turns into a long run thing. There's Ben Bernanke. Hey, tell him we're busy. We get back to him. And the one thing you remember about the Fed is we're mostly about economic stabilization, and we're kind of short run, and we're meeting every 6 weeks thinking about that. But I do think a lot, and we have economists researching a lot, what's the future of manufacturing and how does it dovetail with the labor market? And part of that goes to productivity growth, okay? And if you look, the last 2 years have been a really quite remarkably high productivity growth relative to what was trend productivity growth before, even before COVID. And we're trying to figure out, is that from AI? Is that a one-time thing that came about from, say, now we have hybrid work, and so that enabled an increase in the level of productivity? I have this paper, I've continued to do a little bit of economic research with some of my colleagues, and there's a guy at University of Chicago, Chad Severson, who's like one of the world's leading productivity economists. And we have this thing looking at the productivity of fast food restaurants, which if you look at productivity per worker or per hour, however you want to measure it, in real terms, so take out the inflation, that was flat for 20 plus years. It's basically a constant because the technology is basically the same. You come in, you order, boop, they make your food, you take it out. After COVID, that jumps 20% and it stays 20% higher and it never goes back down. And so we try to figure out what now. We think that it's because, and we were able to document it with some unique data. Basically what happened is a whole new form of demand for food, which is come in and take away, place an order on your phone and just come in and put it. The restaurants figured out we can do this with the same number of employees. We have the demand we had, and now we have a new 20% more demand that just comes from these people coming in and taking it away. That's an example of an organizational process change that's a one-time. That's not a higher growth rate. If the productivity growth rate remains like this, and that's a huge question mark, then there'll probably be a smaller and smaller share of the workforce that's in manufacturing. Manufacturing can boom and prices can come down and incomes can go up, but you need fewer and fewer bodies to have the same amount of output. And we have seen that dynamic play out over the decades in the Midwest. It has contributed to one of the reasons of relative population decline, if not outright decline, has been you don't need as many bodies to do it in sectors like agriculture and manufacturing where productivity growth's been sustained high for a long period of time. They become smaller and smaller.
And what do you hear when you part of your job is you're out in Iowa and Springfield and talking to manufacturers and trying to get a beat on our district. What do you hear from them? Is there a common theme or different
up to
everywhere?
April 2nd, there was a common theme. Hair on fire. The tariffs are going to wipe us out. If the tariffs are as big as what they just announced, our margins are only 5% to begin with, so the suppliers are going to go under, really, really agitated. Then there were some exemptions, USMCA compliant, it's not going to apply. Maybe it's not as bad as what they have said. People kind of coming around to the view of maybe this is sustainable, but still very much dependent on what sector. So we got a major apparel manufacturer that's on our board. In apparel, the impact of tariffs on inflation, much of it is still to come. So they've had the tariffs, now they're feeling like it's established what it is, and so it's going to be distributed over the next year in price increases. In others, they've told us they don't think they can get away with it, that the consumer will push back, and so they're having to eat it. And they're upset about that, and they don't know if they can sustain. And anything touching on data centers is booming like crazy. Right. It's not and they're driving up the prices of everybody else. So in the commercial real estate, there was this whole thing, is commercial real estate going to go down the tubes and endanger the banking system? There are some very bright spots in commercial real estate, one of which is data centers, and the land for data centers and electricians. Evidently, it's extremely hard all through the region to get tradespeople to come in and build anything or renovate anything because they're all out building the data centers. So I'd say that one's a theme. And I just was up in Milwaukee and we toured Molson Coors and saw the brewery. Fed rules forbid drinking before 4:30 p.m. So there was no drinking, but we could see where the beer was. There are a couple of idiosyncratic industries where they've had some tough impacts, even though beer itself is a predominantly domestically grown ingredients, domestically manufactured. So in a way, you'd kind of be like, well, why would tariffs matter? They have backdoor mattered through the supply chain and some other things.
So you go back. So the history of tariffs. We've got precedent. I don't know the answer to this. You look back at Smoot-Hawley and various tariffs over the last 100 years. Is there a trend line or a
there's a trend line. Tariffs are terrible. Look, as you join the central bank, you're out of the fiscal policy business. Okay, you're out of the partisan business. People take the job extremely seriously. So I'm not going to, the president and Congress in their wisdom can pass whatever tariffs they want. And I always say our thing at Chicago Fed is like the Chicago motto, there's no bad weather, there's only bad clothing. You tell us what it's going to be, and we'll go figure out the jacket and do our job. Tariffs are part of the weather conditions. That said, tariffs drive up prices, and they drive down employment. And if you apply the tariffs to intermediate goods, that is the parts, components, supplies, computer chips, steel, aluminum, that's worse. Okay, there's a sense in which now you just turned what was a tax only on imported things into a tax on domestic production. Okay, remember, imported goods are only 11% of GDP in the United States. We're mostly a domestic-driven economy. So there is a sense in which tariffs can be, if not irrelevant, they don't have to be a material destroyer of everything if they stay in their lane. And they might stay in their lane. And if they do, fine. Well, let's go. Before April 2nd, my view of the economy was we're at pretty stable, full employment. Inflation is above the 2% target, but it's coming down. And to me, this is a path to 2%. I called this thing the golden path. And if we're on the golden path, the rates can come down a fair amount. I think rates are going to settle some fair bit below 4.5 where they are today. And so my view was over the next 12 to 18 months, this thing can just keep coming down. Now we start throwing a bunch of dirt in the air. As long as we're still on the path, you get the dirt out of the air, we're still on the path, then I'm fine with rates can continue to come down. But this thing that we're hearing throughout the district is there's a lot of uncertainty. We don't know. We don't know if this was one and done tariffs, that'd be one thing, but it's not one and it's not done. And it's like if we're going to wake up tomorrow and it's going to be 50% now on the supply chain, we did learn in COVID that if it's big enough to disrupt the supply chain, that can take a lot longer. That can be a lot more persistent than the kind of the theory said it was supposed to be. And that was the root of why Team Transitory got themselves embarrassed.
All right, this one's going to be uncomfortable.
Okay.
It's not on the list of things I'm supposed to ask.
Okay.
So, Cubs or Sox?
Now, the thing is, now I have to be Mr. Neutral. One of the toughest days for me was day 2 when they were like, oh, the Green Bay Packers are now in your district, and you have to root. I was like, what?
Wait,
That's
an easy one.
We did a trip to Green Bay, Wisconsin, and it was like they literally toured me. There's a little incubator that's right outside. It's called Titletown. And they were like, oh, we're going to show you Titletown. They took me out. They were like, here, you can touch Lambeau Field. I was like, this is the lowest day of my life. And so now I have to be for both Cubs and Sox and Detroit Tigers and Milwaukee Brewers. But
it's the hardest part of the job.
As I said, we're the only district that's ever produced a Pope. And a couple weeks ago, I threw out the first pitch at the White Sox game. And
I was like, pitch.
I can't.
Strike.
If this thing goes in the dirt, the headlines are going to write themselves. Fed off target, fed, this. And I was like, oh, please, don't let this go in the dirt. Boom, I threw a strike. You saw the video. You saw the video. So I feel like the Pope did 7th District a solid on that one.
Phenomenal pitch.
Yeah.
Phenomenal pitch. All right, we're supposed to take some
Q&A.
Let's
take some Q&A.
I'm gonna I
coming
like
in
the good
on
old
that?
days where you give them a microphone.
Yeah, right.
You Oprah Winfrey
instead
the
they're
thing.
coming in on here?
It's coming on here, so I got to put a
Okay.
password into this thing.
Now that's even doubly dangerous because
I
now
know.
you don't even know who
It's not bringing up
who
the
asked.
password. I know. That's
Well,
what I
you
said.
call it up.
If
I'll
you have
tell
to have a
when I
microphone
used
and
to
they
work-
see your voice, you
when
say
I
it,
used to
they
work-
can't throw you the
when I
nasty.
used
Oh, it's
to
coming up here.
work in the White House. It
85.
was the financial crisis that happened, and there was a conference on small business. And the question was like, why is small business not recovering faster? And the answer was because credit conditions were super tight. So they're bright lights, and so you kind of can't see the audience that well. And so I said, if you have the microphone, just assume you have the floor. Just ask your question.
Oh,
so there's a guy right in the front row, stands up, he takes the microphone. But I did not know there were 2 microphones, okay? So that guy stands up, and somebody else starts asking like a total, not even a question, like making a totally offensive pronouncement about, the problem in this country is women took men's jobs and the following groups are all lazy and something. And everybody thinks it's this guy standing in the front. And then finally he's like, it's not me! He throws. So, but now we're going to have that problem.
Yes.
Yeah, now we're going to have that problem.
You are. Yeah. Deep dish or tavern style. No, that was not on there.
Deep dish or tavern.
I will filter out the crazies. I will be the crazy filter.
Okay. You can't even appreciate that Dave Habiger is like, I'll filter out the crazy. Like,
they don't know me well enough.
They don't know. They don't know. Dave is the guy. You need one person on your board who doesn't have a filter. We'll just tell it like it is. That's Dave. So then Dave is the filter. It's like, oh man,
you're in trouble.
Oh man, oh yeah.
You are in trouble. Okay. Oh, and there's names. So John G.
Oh.
John G says, what are the expected impacts of tariffs on producers? We kind of covered this, but let's keep going on it. Producer pricing from domestic suppliers increasing prices due to reduced competition. I think you kind of hit it.
Okay, that's one component. That's an interesting wrinkle that if they put in tariffs, one of the things is if you're buying the stuff that is coming in, you got to pay more. And one of the things is if you're using the things that the people who buy that in, then your price might go up. But there's a third factor, which is in not as competitive industries, the tariff can serve as cover to the domestic producers, even if if the tariff is 10%, they raise 9.9%, and because what else are you going to do if you're going to go buy the foreign one? It's 10. The economists argue about how big of a deal that is. As you might imagine, it depends a lot on how competitive the industry is.
Let's get the rate one out of the way. You must get this.
Should
I get my interest? Should I get my mortgage in 2 years or 1 year? All right, so interest rates, in your opinion, if tomorrow's job numbers come in light, will the Fed lower interest rates in September if they come in, or raise if they come in hot?
Okay, I should have started with the FOMC rule, the Federal Open Market Committee communications rule is I'm supposed to say, I speak for no one else on the committee than myself, and I can't speak for the Fed. I don't say, here's what the Fed thinks or what the Fed does. In my view, I don't like tying my hands before we get to the meeting if there's important data to come, which there is. We're going to get some inflation readings and job readings before the next meeting. And I like hearing from my other colleagues. It's one of the coolest things. If you're an econ nerd, it's one of the coolest things in the world. You go into this huge room, biggest table I've ever seen in my life. Shades come down so no one can spy on what's being said. No phones, no anything. It's like you're in the Situation Room. And then we're going to go around the room, and Jay Powell's going to be like, here's where I think we are in the economy. And they're going to go, Governor Waller, what do you think? He's going to say his piece, and we're going to go around the table. I like hearing what they have to say before deciding. Now, that said, I told you where my head is. Before April 2nd, I thought, I don't know if it's this meeting or next meeting or 3 meetings from now, but I thought rates can come down a fair amount. And if we can get past the disturbing parts in the inflation data, I still think that's where we are. But I add that caveat because we've had 4 or 5 months of inflation data since the tariff started coming in. The first couple of months were extremely benign, and I kept saying, hey, it's staying in its 11% lane, and if we get some more readings like that, I'm going to be totally comfortable saying we're still on the golden path. There's no problem. Then we got a reading that was less benign on overall inflation. And now in the last reading, services inflation started blowing up. I hope that's a blip and that when we get some more, that's going to go back down, because it's hard to tell a story of how services inflation is coming from tariffs and is going to go away when we sort that out. So I don't know. It's a live meeting for me, but I haven't made up my mind on that.
I'm going to go do an mHUB on here, and Chris
You're going to
S.
do an mHUB?
mHUB.
And have an IPO and a big success, or what are you saying? You're going to do an mHUB?
We're going to stick with the theme where it's founders and tech people, and as a software guy founder, I'm going to go get off this whole macro. I'm getting tired of the economy talk. What key macro signals? So there's a little bit in there.
Okay.
They threw that in there
What key macro signals?
because they want to know if they're just doing that because this is like
what to watch?
I'm going to finish this. I'm going to read what Chris S. has to say. He says, what key macro signals should early stage founders watch in the next 3 to 5 years to align with the Fed's view on innovation, manufacturing, and resilience?
Well, Chris S., if that is your real name, I would say that the single most important data series that nobody talks about, so does that make it underrated? The single most underrated data series is, and I love that you specify the time frame, 3 to 5 years, because that's why this thing is underrated, is the productivity growth rate, okay? It's one of the most noisy series. So that's why they don't do a CNBC countdown of like, ooh, the productivity growth rate is coming out today, because the thing is up, it's down, it's whatever. But over a longer period, that's the most important number there is, because it determines how fast can wages rise without generating inflation, how fast can the economy grow without generating inflation, and that is quite fundamental to what the Fed is going to do over a longer period. We have, the last 2 years have looked like kind of what the late 90s was. And the late 90s was a period where there was a big surge in productivity growth, and Alan Greenspan figured that out as it was happening. And so when people were pressing, if we're growing this fast, that's bound to be inflationary, he said, no, it doesn't have to be. If productivity is growing this fast, we don't have to raise rates as much in the short run to prevent inflation. So I would highlight that one.
I would say as a startup guy, I wouldn't worry about the Fed. Do your thing, and whatever they're going to do, they're going to do.
Why did a guy join the Fed board who has that view of the Fed?
Your
That's
success as a startup
but it's good.
If the Fed is going to dictate whether you're going to be successful in your startup, you got a problem.
That's where he said.
And nothing against the Fed.
Yeah.
There's a lot of Chris's in here. Holy cow, I think someone made this up. Okay, so Jerome Powell wants to know, on Odd Lots, on the Odd Lots podcast, you discussed the 4 horsemen. You kind of covered this, but the 4 horsemen of the labor market, vacancy rate, job finding rate.
This was a week ago, so
layoff
don't
rate.
Feel like I haven't been saying that same thing for a year. that
Unemployment rate.
was at Jackson Hole.
Do they still outweigh inflation? So I think the question was,
do they still outweigh inflation? In a way, they haven't outweighed inflation. The main dominant thing of the last 5 years, as you know, is inflation got totally out of control, way above 2%. And we've been fighting to get inflation down and down and down and down. And we almost did it. We were very close to 2%, and I felt like we're on that path. If jobs were to outweigh inflation, it would have to be of the form, inflation is mostly under control or not worrisome, and the job market is starting to deteriorate. I still don't know that it is. I think the worst indicator is monthly payroll jobs numbers. That looks weak. But like I told you, I don't want to over-index on that because I know a lot is going on in immigration, and I know a lot is going on in labor supply. So I don't know that it outweighs it. I'd say right now we're still kind of looking at both sides.
All right, and I got the wave that says the hook is coming. So I'm going to do one more. Last question.
Chris.
Chris, it is Chris.
Yeah.
Everyone, I'm honest. You can look. There's 4
Yes,
Chris.
I believe you.
Okay. So Chris wants to know. Last year you told U.S. Farm Report Ag.
Man, is this like
hey,
birthday magician
Yeah.
nightmare? They're
Yeah.
like, stuck it in his arm. Okay, I told the U.S. Farm and what? Horse and Hound magazine? What did I
U.S.
say?
Farm Report Ag
Yes.
was readjusting after a few strong years.
Yes.
Are we still in a reset? How does your ag factor
On
into
agriculture?
Yeah,
Look,
I think
it's a
ag is.
it's a tough moment in agriculture because basically output prices of agricultural stuff have been low. So there hasn't been as much food inflation until recently. But the costs of a lot of the stuff they're buying has not abated. That's one of the areas where inflation has been pretty substantial. So that was already squeezing them. Farm incomes, if you looked at it, we're experiencing a tough bit. And then April 2nd came, and the either explicit retaliation or quiet retaliation that China stopped buying U.S. soybeans, and a bunch of the agriculture sector is agriculture and manufacturing are the 2 most export-oriented sectors in the United States. So they've been feeling it, and I feel like whatever I said then, that was 2 years ago, it's even more so now. That's a bumpy patch.
Thank you, Austin. You have a long day. Thanks for.
Hey, thank you for
answering
what you do
questions.
for the city and what you do for the economy. It's really important.